So as I see, we are online right now. Okay, so I'm Dina Mostovaya. I'm a PR consultant and the founder of Mindset Consultant. So I do PR and communications for startups and venture funds. And here I am with my colleague Anastasia Karpova. So she's from Forbes Russia, and we will ask some questions. So let's start. Who wants to be the first?
I'm happy to go first as an intro, I guess. Hi, everyone. My name is Nuno Goncalves Pedro. I'm a managing partner and founder at Strive Capital. I'm based in the San Francisco Bay Area. I'm also a venture partner with Christian Robotics. So I actually work with two venture capital firms. Strive Capital, we focus on consumer software and software as a service. We've made investments in companies like App Annie, Gusto, Rubrik, DraftKings, OmConnect, Verta Health, and a few others. Our claim to fame is we were probably the first early stage quant fund, so driving a significant part of our deal flow from an analytics engine that we built in-house and also helping us with due diligence. And as I mentioned, I'm also a venture partner with Christian Robotics, which is a Sand Hill Road venture capital firm focused on Series A and Series B investments, mostly around physical tech, but more recently around consumer.
Great. Okay. So yes, should we just introduce yourself, like everybody right now, and then we should ask some questions. Alexey, what do you want to introduce yourself?
We can't hear you, Alexey.
Yes. Could you please
turn on your mic?
Yeah.
Thank you.
Yeah. Thank you. I'm Alexey Alexanov, and I'm a co-founder and general partner at Cabra VC. We invest in US-based subscription-driven companies, mostly which affect onboarding and engagement. It's all about customer engagement technology. And we also do investment in India.
Great.
Thank you.
Thanks a lot.
Yeah, welcome.
Tom, do you want to tell about yourself?
We can't
hear you.
Indeed, was on mute as well. Sorry. Yes, I'm Tom Henriksson. Hello, general partner at OpenOcean. We are B2B software, enterprise software experts, investing in European early stage, typically A-round B2B software companies. We built 3 such companies ourselves in the past to scale and global leadership, and now we've been investing from 3 institutional funds into similar stories.
Great, thank you. Hi, Omiros. Do you want to join us?
Hi there. Can you hear?
Yeah.
Yeah. Can you hear me?
Yes.
We can.
Hello from London. So we are a fund based in London that, peculiarly enough, invests in South and Eastern Europe, particularly in Greece, my home country in Greece. We invest in asymmetry and asymmetric markets, so we find regions that are experiencing a U-turn, and we focus to invest in the right time, just before the upward stream. We are one of the few funds in the country that are very flexible, so we do growth series capital. Somebody's phone, that's not mine.
Yeah, sorry.
I don't know whose that is.
It was me, sorry.
Okay, Dina, which reminds me to close my phone too. So we're doing growth capital in Greece. Greece has an ecosystem of venture capital, which is funded by the European Investment Fund. And then it has large funds, which are by ex-CEOs of the big banks. There was a huge gap in the middle, which we captured. And we're funded by entrepreneurial capital, effectively some of the oligarchs of Greece, some of the industrialists or professionals. We have all been working in London or abroad for a couple of decades, pretty much all my adult life, and we have invested back in the country. The claim to fame, as Nuno called it, is that we made about 57 times our money in Greece so far, which is not a bad record. So we're quite happy with the performance, and we brought effectively quite a few of our friends in the process, which now we have a platform which combines the best of England and the best of Greece. So we're doing investments in the what you will call late stage VC, early stage P. We call it growth cap or dev cap. So that is us.
Thank you so much.
Okay.
I think it's safe to assume if that was in Zoom, it would have been much better. That platform seems to be very difficult to join. I think if we have all done it all in Zoom, it would have been broadcasted much easier. But from whatever reason, I think it's limiting the amount of guests and it's limiting the amount of the presenters who have a bandwidth. I mean, I'm dialing in from the 400 megabps line, so super duper fast, and I still can see the flickering from the other side coming in. It's very hard.
Okay, great. So I'm in touch with Yelena. So she said that Chris is here as well, but we can't see him. Chris,
hi, Dina. How are you?
Yes. How are you? Yeah, good.
Hi,
Where are you now?
I'm sorry. I'm in Hong Kong.
Sure.
Apologies.
Oh, wow.
I can't turn on my video. I was playing around with it, but I think the voice is working. So
Good.
Shall I do a quick intro?
Yeah,
sure. Yeah.
Great. So I'm Chris Fisher. I am based in Hong Kong with a venture firm called Click Ventures. We're a Series A focused global VC fund that focuses on companies that generate some kind of network effect. We're invested in companies such as Event Extra, Memebox, Spotify, Mogul, Palantir, Crave, Link, Equity Zen, you might have heard of, and a few others around Asia and in Hong Kong. I am an operating partner with them. I work with the portfolio companies. Originally, I was a partner for Fund 3. For Fund 4, I'm stepping back to operating partner, and I'm also starting a new hat, working for a later stage fund called GPO Fund, based in New York, which invests in later stage SaaS companies, typically SaaS and some other SaaS-like revenue companies at around a Series B or a Series C round.
Thank you.
Okay, great. Okay, so we should start with the questions, I guess.
I think we have some topics to discuss, and the first is rethinking portfolio companies' go-to-market strategies. What has changed and what not?
Shall one of us address it? I guess, yeah. I actually run a podcast with Bertrand Schmidt, who was the co-founder and now chairman at App Annie, and we just had an episode on COVID, actually a 2-part episode on COVID, and we discussed it quite heavily. But let me address it. I mean, the thing that's changed most obviously is most of us are at home, right? And it's not just startups are at home; venture capitalists and investors are at home as well. So the first element of that has changed in the market right now, in particular if you're fundraising, is there's a little bit of a latency or a lag in how investors are dealing with stuff, because shockingly enough, we're human beings, and some of us have kids and some of us have families, and we have to take care of logistics, and so there's immediately one step of lag and latency in there. The second step of lag and latency depends on your fund. I mean, if the fund is basically linked to limited partners, our own investors, so venture capital investors are called limited partners. They basically, it depends on whether these limited partners are, limited partners that have cash liquidity. And so if you do so-called capital calls or cash calls as a venture capital firm to invest in a company, if they actually give you the cash actually matters as well. So if you get the cash, let's assume your limited partners are doing well and they have the cash to give you and everything is good, then everything's awesome. But if that's not the case, then you actually don't have the cash to give to companies either way. Assuming you do have the cash, the third element that's happening is certainly, and here I'm talking more of a Silicon Valley, Bay Area element, although we do invest across the world. the world has really changed towards being very, very entrepreneur friendly. The terms and conditions of deals here in the Bay Area have changed to become very entrepreneur friendly. And now there's a rebalancing. And I think that rebalancing actually didn't start with COVID. It started with SoftBank and what happened late last year, with obviously a little bit what we saw as an implosion of SoftBank as an investor. And what we're seeing right now is obviously valuations are coming down. They've come down in late stage, they've come down in middle stage, and they are also coming down in early stage dramatically, 20 to 50% certainly in the Bay Area. And it's become more difficult for some of these startups to raise money. And what that means, if you're a venture capital on the other side of the fence, is you can cherry pick. You can become a little bit more aggressive and have a higher bar for the investments you're making. Now, that all said, investors that have capital to deploy are still deploying capital, and this is a great time to be in the market. I certainly think, from the perspective of Grisham Robotics and also Strive Capital, that the fact that both of us are deploying capital right now is actually awesome, because everyone says the basic thing, which is, at this moment in time, we've had a lot of companies created in or around crisis, which is actually factually correct. But I do think there's a lot of amazing companies in the market right now, and companies that can withstand the crisis that we're in will come out of it even stronger. So definitely a great time to be investing.
Thank you.
Yeah,
Yes.
I agree with that. What I've been seeing, especially as it reflects in go-to-market strategies. So as a fund manager, well, first of all, there was a lot of capital raised over the last year, 2 years. It's been unprecedented highs, I think, in most areas of the world. So there is a lot of dry powder out there. There's actually quite a bit of capital sitting out there that's available to be put into companies. But right now, I think, especially the last 2 or 3 months, VCs have been extremely busy, really working with their portfolio companies more actively than perhaps they do in more normal times. A lot of companies are being challenged. In the tech sector, it's quite interesting that some companies are doing very, very well, i.e. Zoom, or i.e. work from home type companies, Slack, this type of tech company, and other companies are doing terrible, like OTA, online travel agents, people dealing with hotels, Airbnb. These kind of companies are suffering dramatically from the lockdowns and from the lack of mobility among people and things like that. So, as is the case in most of these kind of downturns in 08 and 01, VCs kind of have to step back and take a look and assess the situation, as do founders. Founders need to take a look at their businesses, see how they could potentially be affected, make sure that they have enough runway, enough cash to survive for the foreseeable future. If they don't have enough cash on their balance sheet, it's actually probably a little too late by the time we're having this conference right now. But in January, February, you should have been looking, to put some cash on the balance sheet if you in any way can, and start to hunker down for what could potentially be a protracted downturn, or even if it's a V-shaped recovery, there's still quite a bit of risk ahead. So in terms of go-to-market strategies, I think, being conservative on cash, figuring out where you can cut costs, assessing your customers to make sure that they're potentially going to be able to pay you. Look at your, any kind of receivables you might have. Look at any kind of contracts coming up for renewal. Be proactive, reach out to those customers, and spend a lot of time, making sure that you don't end up with a bunch of churn, that you can basically keep your retention high. I find that works pretty well when you're proactive about it and don't let problems kind of slip, under the rug, where maybe a customer is on the verge of insolvency. Maybe you reach out to them with a payment plan. Maybe you try to help them to make their commitments and stuff like that. So I guess what I'm basically saying is to shift into kind of preservation mode, and we're seeing a lot of our portfolio companies are focusing a little bit less on growth and a little bit less on major expansion, and really trying to batten down the hatches, so to speak.
So,
Great, Tom, do you want? Yes. Thank you.
Yes. So because I think the question was actually mainly on go-to-market strategies here, right? So I want to dive in a little bit further into that. I will speak mainly from the perspective of a software business, because that's what I do and what I know. And there was already a mention about the industry. Depending on what industry you're in, you're affected in different ways, and I'll table that for a second. But so that is obviously one very large factor. The other one, how you're affected, is very much in what is your go-to-market model, your business model, your revenue model. Because if you're one of those, and now again, software businesses that actually needs to knock on doors and ask if anybody's interested in buying what you have, and have face-to-face meetings, many of them perhaps to actually get somebody to say, yes, I want it, and then even have to do integrations, maybe on site at the customers, before you actually get the solution delivered to the customer. Obviously, in that scenario, you're kind of screwed right now, because that has completely changed and been taken out as a model. And even if you have some lighter elements in that mix, but if it's still a, let's call it, fairly heavy go-to-market model with fairly long sales cycles with some integrations, you will be severely affected. I mean, we see in the companies that such businesses, I mean, they experience 2 to 3 times longer lead cycles. The customers don't buy much, because if their ACVs are high, they just don't have the budget, and so on. So that's one, place you don't want to be in. Obviously, if you're on the completely different side of the spectrum and you sell, let's call it, fairly light software that is sold online, delivered online, marketing driven as a sales model, and you don't need that much human involvement. Maybe you're even so lucky that it sells itself, it goes viral, and it's totally self-serve. Some companies have that, not many. Usually you need to be a little bit involved. But if you're more on that side, you might not experience much of a change at the moment, especially if your solution is not very expensive. If you get into the bigger ACVs, where there are more stakeholders to actually get the decision done, and big budgets in general will be harder to come by at the moment, then even in that model, you probably will be experiencing slowness, inertia. But if you sell something that's fairly inexpensive and is really needed, regardless of coronas and other crises, then you might actually do quite well. And now I'll come back, finishing it off with the industry. Then obviously, on top of that, depending on if you sell something that actually is needed more now, you might even benefit, right? But even if you have a good model, and if you're selling something that is maybe not that essential, you will feel it. And I'm happy to get into much more detail on this, because this is my passion. But I'll let others speak for a while.
Thank you. Tess is joining us. Hi, Tess. How are you?
Tess.
Hi.
I'm great.
Can you tell about yourself? Because we just started to tell about our companies and about the industry.
Yes, excellent. Thank you. So nice meeting everyone. I'm Tess Howe, a founder of Tess Venture. I myself and actually my team have been investing in early stage startups, mainly now the last 10 years in Silicon Valley. Prior to that, more of a global focus. However, even though we're based out of Silicon Valley, we actually invest in emerging markets. We invest, early stage, essentially now, whether it's Asia or where opportunity lies, if it's with founders that actually feel have good alignment with, what we can add value to. And my background is from a founder operator experience, started very early in startups. And one of my companies that I founded had a acquisition. So from there, that's when I started to decide to give back to other founders and startups and hope to, invest in them, advise them, and help them amplify and accelerate their, progress. So, very, honored to speak with everyone here. Some thesis that I believe in and have been investing in is fintech, obviously enterprise, largely enterprise. Consumer is great, but I think more of what my team understands and can bring value is enterprise. Recently, very fortunate, had a few exits. So even though we invest in early stage, those do take a long time because of the growth of the company. And some companies that I invested early when I came to Silicon Valley, spent some time at Stanford between 2011 to 2013 to get mentored from great VCs and build out my ecosystem of network. Investing early at that time was, great. By now, there's a company in construction tech that exited, a company in biotech, and then a company that is in essentially VR tech. VR tech largely is because of COVID-19. So very interesting to see the changes in kind of market valuation, and then obviously the changes in terms of fundraising, and trying to always think from the founder side and kind of guiding my portfolio company and new companies that I hope that I can help with. Recently, obviously, one of the top portfolio companies in my portfolio is a regulation tech authentication company. The team is an expert in fintech payment, so it was very natural for them to see the need with privacy, which obviously is related to GDPR. And then recently in California, January the 1st, CCPA. So I care a lot about privacy and data usage. And what us as users, consumers, should believe in, and what our rights are. AI obviously is something interesting. I do invest in that, but that obviously has allowed for technology to essentially be able to capture a lot of data. So that's why I believe that while investing in AI, it's also important to be responsible and invest on the other side. So Elena, thank you, and the rest of the panel. Love to see how I can contribute today.
Thank you. So how many portfolio companies do you have, and did they change the company strategy because of the current crisis? So this is the question to Tess and to everybody.
Great. So thank you. So I myself have been investing very early. So through my own personal investments and also some of my other entities, sometimes I invest through special purpose vehicle, but largely now through, combined with Tess Venture, I would say I have over 50 companies. Some in the last few years, definitely I believe in frontier technology. So some of them are in blockchain. And, I think the magic and like the sweet spot is founders that have built real companies that are from, the kind of the traditional world, that understand that blockchain technology can actually be very important to many sectors. So, the market needs to go through these market cycles, and also regulatory and regulation need to be established before critical mass adoption. So I believe in patience, and I think, eventually sticking to some of the thesis you believe in is very important. And in terms of fundraising, startups and portfolios, that are in my portfolio, and also in a lot of my VC friends, the focus of VC truly, when COVID really hit, was to focus on helping their own portfolio. However, I would say if it was a company, what I saw was related to COVID-19, health, anything that involves in this new work tech, this remote tech, was actually still very desirable. And there are a lot of investors investing in it. Largely, even investors that didn't invest in health, that didn't really understand, vaccine biotech, that actually probably never invested in this area, started to put money in. So obviously that drove up the demand. However, on the other side, obviously everything that we thought was very exciting became challenging. Anything that was collaborative, everything that was sharing related. And I think, there are some obviously clear companies and sectors that became very, very, desirable, and even companies that you guys obviously have noticed would pivot into these themes. So, that's one of the first things. The second thing is clearly it is a lot harder to fundraise because we are all working remotely. So that's why it's even more important that you bring on really good strategic investor, or utilize and work closer with your existing investors and existing advisors, or advisors that you think can help you in this next journey, which is in this new normal economy, which is very different. I myself have seen one of my companies that I invest and advise. Limpo, they originally were a health technology that was able to capture a lot of data and help everyone with wellness and focus on just making sure you exercise daily. What they have seen very quickly, and this is a European company, but they're based in Europe, but global. What they have seen is very quickly their technology and their capability was able to help COVID related initiatives. So they actually became very needed in their country. And the team also has partnership with Korean about pharmas. So they, I think today it actually, many teams, no matter where they're sitting in, wherever city, is either distributed and also focusing on a very global market because of technology has enabled us to do that. So maybe I'll pause there, and definitely love to hear what the other panelists would love to share.
Thank you.
If you don't mind, let me add to something that I said earlier, just very quickly.
Of course.
So,
Of course.
my thesis was that depending on your model, if you have a light, fast adoption model, you might survive better, unless, of course, your industry is completely hit. One company example I want to give this is about innovation, and it's a company called Happy Signals. We have not invested in it, but we happen to know them, and they sell this employee experience management software in the ServiceNow ecosystem mainly. But anyways, for measuring how employees fare with IT. And it's a fairly heavy sales process and a fairly long one. So when COVID hit and everybody went remote, they innovated really quickly. So they released a free remote working employee experience management module, which actually got a huge uptake. And although it was free, it resulted in really good business for them because it's got them new customers who use it for free, who then actually became commercial customers for their heavier general solution. So if you're quick, even small innovations might really make a difference. I also hear the noise, by the way. I really hope it's not from me.
Yeah, maybe the person that's not speaking can be on mute. I just to answer the question very quickly, we have over 40 portfolio companies that are active right now across both of our firms, Grisham Robotics and Strive Capital. And I normally classify what's happening in the market into really three camps. So cyclical companies versus counter-cyclical companies. Counter-cyclical companies are not getting super affected because they're in markets that are not affected by what's happening with COVID right now. Cyclical are, and then we have obviously positively affected and negatively affected by what's happening in the market right now. We've been very lucky. We've only have two companies that I'm involved in that have been negatively affected, significantly negatively affected. One is in the travel space. The other one is in the HR, talent acquisition, recruiting space. We've also been lucky that we have actually a very significant consumer portfolio, and a lot of our consumer portfolio is doing incredibly well. We've had one IPO, which was a reverse merger into an IPO, which is DraftKings. That obviously IPO'd just before the COVID crisis really started becoming big in the US, and has gone very, very well. The stock price has gone through the roof, as everyone knows. So it's been a little bit of a mixed bag. I think right now, someone was making this point earlier. I believe is potentially Chris. There is sort of this notion from a venture capital perspective of lack of clarity in terms of markets, and you really can't bet on a bad market, right? So you can have the best team in the world. If the market is bad, likely the company's not going to succeed. So at this stage, the biggest issue is we need to figure out which markets are going to rebound and how. But we also need to figure out the markets that are going through the roof right now. For example, gaming, collaboration, anything related to remote working, which is going through the roof right now. We also need to figure out if those markets are at peak level right now and they will sustain that level afterwards or not. And I think that's the biggest challenge right now in looking at portfolio and helping portfolio, is also to help them figure out markets and figure out how to do small pivots or small alignments, small changes in go-to-market, changes in team, and in some cases make the tough decisions, right? You know, in the case of our two companies that are not doing so well, you know, having that discussion on what's your cut to the bone scenario. You know, what would it look like for you to actually be in survival mode and live to fight another day? Now, no investor wants to have that discussion with their portfolio companies, but you do need to have that discussion, and you need to have it pretty early on into the cycle. Certainly, hopefully, when things started in late February, in March in the US, and probably earlier even in other parts of the world.
Great, thank you. Okay. Omiros, do you want to tell us?
Yeah, I'm glad to.
Thank you.
Alexey, I think it's his frame froze. Look, we are a bit different because, I mean, this is enterprise technology, which is infrastructure, big data, SAAS, and security, and we're invested in all of them. And we actually had a very similar session here from my former business school. And there were about 70 people that came in. We all discussed how we innovate through the crisis. And it's exactly what we're discussing here, right? There are three things that happen. One is you defend the fort, so you provide liquidity. The second thing is that you're trying to pivot through innovation. So, for example, I have an nanotech business in Greece, which exports maritime applications for ships around the world. So once you have dry dogs being frozen in China, you can no longer paint the ships, right? But you can pivot to go into sanitizers using nanotechnology. We have robotics companies that went into a different space. They use the R&D time to come into products, into robot as a service. There's a lot of things you can do. Obviously, the software companies are affected less because people are used to remote working. But I think that the crisis, do not good crisis go away. Crisis is an amazing opportunity to actually both invest, find good companies at attractive valuations, whereas before they would be riding a wave of extraordinary growth in the back of the market. Second, you can look at the good managers. You can see who has acted, who has gone into the right insurance policies, who's managing cash, who was getting a free ride, and who's actually very competent. So I think that the crisis is a fantastic opportunity to separate the wheat from the chaff. And there was a lot of funds which have been built during the crisis. I mean, we had applicants from some of the largest funds in the world, which are dropping out and they are forming their own venture funds, or they want to partner with other fund managers, because now it's a very good vintage year. The vintage years that you're going up during and after the crisis are the best years to invest. Whereas before you were riding a bubble, and probably most people invest in over sensitive valuations, right? But I think COVID is a very good opportunity for quality investments. It's a very good opportunity for fundraising, for vintages, and a fantastic opportunity to really test your captains of your ships, how well they can steer those boats.
Yeah, I totally agree with you, Omiros. And I see that there is a lot of opportunity for the founders, because after a massive layoff, a lot of engineers and managers become available for hiring for a reasonable price. And it's good for hiring to have enough revenue and money. And for investors, it's a good time to invest, because a lot of founders, as you said, show how good they are in management and execution. Because first, that we asked in the end of February, I think, we asked all portfolio companies to reshape the budget and make it as long as you can, lasting for at least 12 or 18 months. And then we helped them with a PPP loan, which was very supportive initiative of U.S. government, and it was really helpful for many of the companies. And it's a good time for negotiation, because our sweet spot is a post-seed company, when the company had funding from seed, and it's after 6, 8, or 10 months after previous funding, and we can make a bridge into new company to Series A, and the terms are pretty nice, and we like it. And another thing for a software company that brings amazing opportunity is that I see the crisis unveil a lot of sales opportunity in terms of old school industry, because now we see a really big trial of software for very conservative users and decision makers in old school companies, and it's a good time for sales.
Okay, great. Should we go next, or should we go for a pitching, Elena?
Did you ask all the questions?
Do we have some more, Anastasia? Do you have some more questions?
I think we
It
have
was
a
the first question, I think.
I think we have a question also about, but I think we already mentioned.
Yeah, I think that was the first question. I think the next one was rethinking portfolio company priorities, cash runway versus product advancement versus sales.
Yeah. Thank you very much.
I think we kind of covered some of that, in that cash runway is, definitely, everybody's kind of looking to extend the runway, look carefully at ad budgets, figure out what's working, double down on what's working. Don't necessarily assume that what worked pre-COVID is what's working for you now, that kind of thing. But it's all about runway right now.
Yeah, and I mean, on that note, we like our companies to try to have at least 18 months on runway right now. And it comes mainly from the fact that it's really hard to plan when you don't know yet completely the impact, because it hasn't been going on for that long, and we don't know how long it will last with what impact. So we try to get them to have an unusually long buffer before they need to either raise more funding or just in general, come hopefully to break even or such to feel really safe. It's a very difficult time when it's hard to guess the next 3 months, not to mention longer periods.
Well, there is also the element what kind of a seed you are, right? I mean, before it was mentioned by Nuno, I believe, about the ability of LPs to invest. So we're FCA regulated, the equivalent of SEC in America. Over a particular size, you cannot be not regulated in Europe. And we run administrator, ours I think is managing about $500 billion. And when you're getting money from your LPs, they have to be able to put it up at any time and upfront. And when you sign a deal with your portfolio, you're supposed to represent also that strong financing platform. So one of the things that you want to do is test your relationship with your portfolio at the time of the crisis. If you go up there and start negotiating runways and don't appear as a partner, or you squeeze them out of the term sheet, maybe that's once things return back to normal, maybe you are flagged as as a hawk who is trying to look for a bit more equity at the peak of the crisis. I think the number one thing we should do, right, is like a father to a son or to a daughter, is to protect, nurture, and develop. Make sure that these people can actually do their job without having to go to nightmares at night if they will survive the next day. Make sure that these people can actually perform and innovate and be able to vision again a way out of this tunnel. rather than counting every day their payments. And I think it's very important for us to have the responsibility to provide that level of comfort to our companies and to any partnership, because partnerships are tested in difficult times, in testing moments, rather than when you're riding a market. It is now that you're proving yourself if you're a partner or just some money that betted a few $1,000s. I mean, we bet a few million rather than thousands. But I think now it's an opportunity for us to prove our worth in this market, not just financial contribution, but strategic partnership and a strong foundation.
Thank you. Shall we move to the next question about corporate VC and financial VC? What COVID has surfaced having them in startups cap table?
What I've observed until now, there's been a step back certainly from a few corporates that were very aggressively investing. And it's normal because a lot of corporations are going through their own complexities, large corporations, so they need to re-equate how they deploy capital. And a lot of these are actually deploying capital directly from their balance sheet instead of a fund. I would say this might be actually a really good time if you're a corporate to buy companies. And so if I was in their position, and I've been in their position, I used to head strategy, corporate and business development for a few corporates over my life and my career. I would basically be looking for good assets that I could buy out at this stage. And we've seen Uber being very aggressive in consolidating a couple of markets. And we've seen a couple of other tech companies that have really been aggressive going into the market. I do think this will change. Again, it's an item and an issue of clarity and cash flow pressure at this stage. I do think a lot of these corporates will come back to the market. But if I was in the position of a lot of these corporates, I'd be certainly amping up my corporate development M&A focus.
Yeah, I agree with that. I also have a CVC background many years ago. And I took a quick look at some data on this because I was curious.
Anyone else
actually,
has an opinion on this subject? Thank you very much, Nuno. Corporate versus financial.
Chris was speaking. Yeah, I think so.
Oh, sorry.
Go ahead, Chris.
Yeah. No, I was just going to say, I was able to find, so this is a US number, but Q1 this year was 13% down from Q4 of 19, which is remarkably little compared to, a lot of the VC deployment is down in the 30 or 40%. So actually CVCs seem to have reacted a little slower than I would have expected. But I do expect they will cut back for the question that Nuno just mentioned. These guys often are having to apply for budget, or, these larger companies are also sometimes suffering in certain areas. And those who are suffering, this is a very tempting place to take budget. Usually cut ad spend first, and then you can kind of cut some of these programs. But I do agree, this is a great time for them to actually be out and active in the market. I would expect that a lot of the serious CVCs would be looking at a little bigger deals because the valuations have come down so much in certain areas. Certainly not in the public markets, but in the private markets, I think they could be looking to make maybe more significant acquisitions rather than the earlier stage stuff at this point, because right now they're going to have a little harder time to justify each kind of investment.
I don't know, guys, I can give you perhaps a glimpse of ray of hope because in our market, things are booming. And I can give you some data which are relevant to you. So when you, by the way, Chris, you say CVC, I'm thinking of the CVC Capital Partners, which is a fund of 75 billion. So
nothing to do with Citibank.
Yeah, not Citibank, CVC Capital. With regards now to the corporate ventures, I mean, in our market where we invest, and I said before, we invest in growth capital in Greece, right? So in the last 4 weeks, Microsoft bought a robotics company called Softomotive. You can Google it. Think Silicon, was sold a few weeks ago. It was 1 year holding from the private equity fund that holding. It's actually people that we know, they are called Metavalon in Greece, a small fund that is doing phenomenally well in that market. Actually, out of the same fund, we're about to experience also another deal, which is oversubscribed, which I try to go into collaboration. And I know they are oversubscribed right now. It's a deal relating to logistics. And we know already there was a Graphing Capital in London, or whatever they're called, Graphing. They invested in Omilia, which is an AI, 20 million Omilia, which is 20 AI voice to text. So that is in the last 4 weeks, right? Particularly the Microsoft deal. I was rather impressed because the CEO came in and talked about it as part of his overall speech, right? And that was in a tiny market in Greece. In the same country, you also have Elon Musk, who opened up an R&D facility inside the university called Democritus, the Tesla facility of R&D there. So I think there is a very big gloom and doom for certain industries, but people who are visionaries will see this as a phenomenally good point to buy cheaply, because people who are growing exponentially, they will actually demand very high prices back in February and January. And I think now it's a good time to invest, and also it's a good time to capture opportunities in even cyclical companies that will experience that deep dive, but then they will come out much stronger, much leaner, and much meaner. So there is certainly a glimpse of hope there. That's why we can see a lot of vintages from very big funds which have come up. I don't want to advertise them, but there's over the last 6 weeks, for people who have access to the major databases, you can see the vintages that have come up are phenomenal. And across all lines, VC, credit, debt, everything in between. And we will see obviously a lot of NPLs, but that's a different story, which is outside of us altogether. But I think that people who know what they are doing, this is a good time to buy. M&A should be boosting by the end of next year.
Great. So we have another question. Do you have any successful pivots with your current portfolio companies? Chris, do you want to take this question?
Sure. We have a couple that are suffering pretty hard. We have one company that lets out film equipment, for example, like video equipment in New York City. It's called Kit Split, and basically film production in the U.S. has been shut down for a couple of months. So they've basically gone into cash conservation mode, full stop. The one successful pivot that we had a social ticketing platform called Get, and it's essentially, think about like an Eventbrite type of platform, but it's more for clubs and university groups and more informal type of events. The in-person stuff obviously was shut down in most of the world, but they were able to change to a kind of virtual meeting type platform. They were pretty proactive, got out a survival guide that they sent out to their customers, and actually had a pretty decent conversion rate of getting these people to continue their subscriptions and to do social ticketing on kind of Zoom type events. Otherwise, actually, pretty much we've got about 35 companies in the portfolio. Those are the only two that are dramatically affected by COVID. So that's it.
I'm really sorry, I have to go to another call. Thank you, everyone, and have a great day.
Thank you. Thank you. Bye.
Thank you.
Okay. Do we have any other stories of successful pivots in nowadays from you guys?
I mean, small pivots, right? Changes around go-to-market, changes around marketing and sales, more aggressive inside sales, really stopping all the elephant hunting, as I call it. So all the, field sales piece. As I said, most of my companies, I have a very significant portfolio in consumer, so those companies are doing necessarily pretty well. The only thing I would add in terms, it's not so much again a pivot because there's no business model change or shift, but more from an operating model perspective, is obviously the remote working conundrum. We've always been very positive towards distributed teams. I wouldn't say fully liquid, but certainly distributed. And with what's happening, we've seen a couple of our portfolio companies that were a little bit more centralized in the Bay Area or in other parts of the world. One that comes to mind was in Europe, in Southern Europe, really becoming much more distributed by nature. Actually, by virtue that their employees were stuck in different places in the world. And so they started working distributed, and now that's shifted the culture of the company significantly. Again, no significant pivots on business model.
For us, actually,
Great.
has been transformational.
Sure. And we supposed to, yeah, of course, go ahead.
Sorry. So for us, we have, the pivoting was actually phenomenal. We had to change completely the course of direction of some of the companies for a few months. So we have an nanotech company which serves the construction, maritime, and photovoltaic industry. And during the period of the crisis, they also innovated internally. They created a whole new business unit within 3 months with one of our portfolio directors. And they are now going, actually this month, into the cleaning industry, in sanitizers using nanoparticles. So for them to start from the beginning to the end, new products, new labels, new designs, new production units, CMOs, own production, all of these things all happen within a matter of about 12 weeks, which was phenomenal. And we have very big expectations from that unit. Another company that we have in software, so that's a company called Nanofos. Another company that we have in software called Terracom, and they are one of their star products is a product called Cure Patrol, which they are guard management. The same software can also be used to facilitate access to doctors and to monitor them, or doctors, nurses, people who are susceptible to COVID, and geolocations together with hardware and software with beacons. So they actually work with us to have an offer, a global offer, to give their software for free to all hospitals or healthcare workers worldwide. And in fact, it was an offer that we promoted to Financial Times, Bloomberg, to I think it was read by 150 million people from the promo materials that I got back to back. It was up on 165 websites, which in theory covered 150 million people. And the last but not least, a robotics company, a company called UGR Robotics, which they were doing solutions custom made. They took the downtime to create 11 ready-made solutions. They actually took the finances of the bank and they innovated into going robot as a service. So they could go to customers and say, we understand it's a COVID period, it's hard to buy, but you can lease this from us. And also they went into the sanitizing business. So they started innovating with us, having a combination of software and hardware to look into sanitizing solutions for hospitals and for manufacturing. So the opportunity for us, it was very deep pivoting, I have to say, and it was a good opportunity to see how the managers were reacting, how the production and R&D was reacting, and the most important thing, to see how important is the intellectual property and innovation, not just organic sales, but trying to create value through other means, IP, patents, R&D. I mean, and of course, during this crisis, we even submitted a new patent during this period. So for us, it was an opportunity to put everything to the test.
Great. Okay. So should we start the pitching session right now?
Yes. Let's do the pitching session. And so the pitching session will be as follows. The first project will present for 3 minutes, then investors will ask questions for 3 minutes, and then we move to the next. And the first project to pitch is Inspector Cloud. Alexander Berinov, please turn on your camera and please share your presentation. Hi.
Yes. Can you hear me now? Yeah?
Yes. Hi. Hello.
Yeah, sorry. So our solution is helping FMCG brands to analyze shelf space in the stores. We are providing to them the mobile application, which can analyze the photos through the computer vision and get actionable reports on what is sitting on the shelf, checking the KPIs like planogram compliance, share of shelf, on-shelf availability to the certain SKUs, etc. So in terms of the traction where we are now, so we are now analyzing 17 million photos per month. We are generating 95,000 USD per month from the companies like PepsiCo, Henkel, Unilever, Schwarzkopf on the right, yeah. And we are growing 30% month over month since actually the COVID-19 situation started, because the companies want to know exactly what is going on in the stores that they cannot visit. So it definitely looks like that, yeah. What is different from other solutions on the market is actually that we're analyzing the photos in real time and not using any people to fix the inaccuracies, unlike Trax Retail from Singapore or Vispera from Turkey. And we are actually also able to provide from 3 to 4 times less expensive solution for FMCG brands. In terms of the team, so my CTO and founder Pavel Boyko holds a PhD. Viktor Limpitsky is our research advisor, is a computer vision scientist guru from Eastern Europe, and Steven Kruger is one of our mentors for the retail. The market is quite huge. It's growing since actually there is all the brands realize actually that they can fix the inaccuracies on the shelf and get the perfect store concept enforced with the computer vision. In terms of the acquisitions, the market is actually demanding more and more solutions. Trax Retail is one of our competitors, is buying company after company each quarter. In terms of the expansion, we have now 5 million worth projects in our pipeline and selling directly in Poland and in Europe, and also building a sales office in Brazil. At the moment, we have 500,000 K in our pocket from our investor for this round, and we are looking for another 200, 300 USD. Ideally from a company that has prior experience in retail tech and who understands well how to actually help us to scale up the technology for a B2B SaaS business. So that's it. Thank you.
I cannot not comment in perfect timing, 3 minutes sharp. Question.
Well done. So Tom here. I mean, retail tech in general is pretty tough in the last even few years, and especially now. But good to see that there's somebody who benefits from the crisis. I've seen a couple of similar companies, not exactly the same solution. And I guess my question to you is, when you work with these mega brands, who do you actually sell to in the brand? Who actually pays for this? Is it on the sales side? Is it on the marketing side? Is it analytics people? Who? Because it makes quite a difference based on who the actual customer user is.
Yeah, so the main actually customer inside the brands is the sales and analytics, basically, yeah. So it's more like a direct sales, but we know actually the roles, and it's not that actually hard to track the right guy who can actually make a decision and roll out the solution.
Good to hear. Just wrapping this one up quickly. So I like that it's in sales, because obviously budgets usually are better to come by in sales if you can show real return on what they buy from you. How long are your sales lead times on a, let's say, local versus local regional level, not necessarily global, because global is always super slow? I think he might have dropped off.
Can you hear me?
Now you're back. You dropped off.
Yeah. So I told actually that the average time is up to 6 months time. Yeah, it's a B2B enterprise sales, and so but the LTV time is 3-4 years because they have actually once you're solving their pain, actually they will pay for you to you, yeah, for years, yeah, if you're not screwing up, yeah.
What is actually distinctive about your product or tech, right? So what is different from other solutions in the market? One of the key questions, for example, is the quality of image you need to do image recognition at scale, which requires quite a lot of quality of image, and therefore you need to replace CCTV cameras, etc., in retail, blah, 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 blah. So what's distinctive about your tech stack and your product?
Yeah, so we started actually with 100% automatic process. So we don't have any guys who are fixing in the background actually the recognition results. Yeah, so the accuracy is quite high. Automatically, it's up to 95-98%, and it is actually in real time. So we're analyzing one scene which actually combines up to 10 photos in 20 seconds. Yeah, and getting back to the application. So it pretty distinguishes us from Trax, which is actually the employer #1 in Sri Lanka, because it employs vast amount of people who are doing the manual search of the goods on the photos. Yeah, and also it's we're working on a on-device recognition. Yeah, which could be offline. Yeah, and pretty done on a Apple iPhones. Yeah, with the seconds. Yeah, so you take the picture and instantly you get the result. That's actually what we're now doing and trialing, hopefully in next 2 months with the big international tobacco brand.
Okay, thank you very much. And dear panelists, can you please fill in the table which I sent you this morning with the startups and the marks? We would be very grateful. Thank you, Alexander.
Thank you. Bye-bye.
And the next speech is Seal Deal. David? Please join us.
Yes. Joining. Hi everyone. So I need to open a document. Okay. Yeah, hi. My name is David, and I'm the founder of Seal Deal. Sorry. Here. So what's the problem Seal Deal is working with? M&A transactions are very complex and involve many risks, such as financial, tax, or legal risks, as you as investors may know. These risks can be insured via specialized brokers. The problem with such is that they are very costly and they take a lot of time and put extra pressure on such transactions. So in the sense of this, you should have a minimum transaction value of your deal of about 30 million euros to make the insurance product economically feasible. And resulting from this, as the big chunk of the M&A market is below 30 million euros worth a deal, 70% of the worldwide transactions are not insured or uneconomically insured. The solution towards this is Seal Deal, which is a software that helps brokers, investors, and MGAs to automatically analyze the risk and close their M&A acquisitions fast, cheap, and transparent. Meaning we are basically doing the entire human work into a digital workflow, decreasing time and cost with giving clients and potential customers access and transparency of the entire market of insurance product for their transaction. How do we make money? Based on a commission of about 30%. Yeah, it looks kind of small, but when you calculate this up, it gives a really big chunk. So the average commission we are charging is about 1,700 euros. The average commission that is paid by human brokers and MGAs is at least 7,000 euros, usually way much higher in the areas of 15,000 K or something. Anyhow, this will give us still a revenue target of about 600,000 euros in 3 years from now. Short overview of our team. So myself, background from investment banking and M&A, where also this idea was created. Nikki, she has 20 years of experience in M&A insurances. Basically, she was building the entire German market for this specialized M&A transaction product. Daniel, our CTO, and we have another one with Thomas. He's our M&A consultant, so he basically is doing the sales towards the private equities. Where are we standing at the moment? Yeah, we had a good market sounding, so we are definitely pre-revenue at a pre-revenue stage. We have already our MVP launched and tested with a couple of clients, like test clients. And we could secure basically 3 great cooperation partners, which is one, King Woods Mallison, which is a top-tier international law company who's providing us with M&A law knowledge and is also testing our services from time to time as soon as we're launching new features. Amaniki is providing us with the M&A insurance knowledge, is a broker basically. And yeah, HDE, which is one of the biggest insurance companies from Germany has a minority share in Amaniki, so they're working also with us together, giving us the infrastructure, especially in terms of sales and marketing, and also, of course, as you can see now, the credibility having this logo on our pitch. So financials, what we're looking for, as said, we are pretty early, so we're looking for kind of a small amount of 600,000 to basically be market ready, more or less. The big chunk of this funding, of course, runs into HR topics, especially for development and looking for software engineers. Yes, that was basically everything about Seal Deal, really fast and quick. Thank you very much, guys.
Questions?
Thank you.
Is this like a, sorry, Omiros, go ahead.
No, go ahead. No, I'm good.
Sorry, just a very quick question. Is this not like just a product idea for an insurance company? I mean, insurance companies can do this as a product. You know, what distinguishes what you're doing? I know you're launching this as a software as a service platform, and not necessarily as a product. You might have to go into a product line at some point, but why wouldn't insurance companies at some point figure this out by themselves? Or isn't the money there? Isn't the money in the underwriting?
Yeah, it's twofold. On the one hand side, it's basically because this M&A transaction is a really niche product. So the teams coming from the insurance company itself, they are so small actually, and this is why you have the MGA. So basically the workflow is you have the insurance company, then comes the MGA who has the capabilities to sign the risk, and before the MGA there's the broker coming. So it's basically kind of It's not something like cyber polices or health insurances, which is like a really fast and easy standardized product. So it's kind of small teams. And as the insurance companies are not working for themselves, so it's always with the brokers and the NGAs, and those teams are very small and not, I mean, sad saying, but it's true, investment banking is really old economy when it comes in terms of how to work with due diligence, how to read contracts, etc. So it's basically, yeah, how to say, I was shocked when I was thinking about this idea a year ago, that there's basically nothing great outside. And basically there was also the feedback that we got from our market sounding in the first instance that it sounds really interesting. Yeah, so it's basically, I would say something around, it's too niche product. And second, the teams are too small that they really can focus on something else than just doing their deals. Because in the end, if you're not working on transactions that are in average like 200, 300, 400 million euros of their transaction value, you don't do the small ones, right? Because you cannot insure them. And as soon as you got the market open there and just going through, because it's basically, especially when it comes to real estate deals, it's really, really standardized, and you can really great, work with automation in that area.
Hi, David.
Hi.
I'm Omiros, and I'm based in London from a fund called Brookstreet. Before I set it up, a private equity fund, I was an M&A banker for a number of years. So I kind of understand a little bit about what you're trying to do. I can tell you that perhaps there is value to talk to the big teams like IAG, March, etc., and Zurich, but perhaps gear it towards transactions that have tension. For example, contingent value rights. There's something in our industry called contingent consideration structures, and I'm trying to be very brief because otherwise I will get too technical.
Yeah.
So if you go into CVRs, put call options, and bridging mechanisms, valuation bridging mechanisms, that is where you have the largest need for M&A insurance, and in fact, the largest need to trying to hedge some of the risk that you're taking. I don't think you have a lot to offer to the mid-market, and sizes that you said before, the 200-300 million deals are mid-market deals. I mean, investment bank will consider 100 million to a billion to be mid-market, even lower mid-market these days. But I think in the large deals, particularly the deals that go into very big complexities with CCS, contingent consideration structures, there may be something there. The question is that you're discussing to KWM, and I wonder, KWM in London was the former team of SJ Berwin, okay? SJ Berwin used to do 3,500 deals just for funds in M&A. The question is why they haven't developed something like that, how they outsource it. If it's actually has to be part of an internal team that will do it, or it's a product. I think I have to agree with Nuno that I understand where you're going, but I can see you very much absorbed as part of the vertical team versus an independent solution. I think that's the risk going there. What is your feedback from the market so far?
Actually, we had really to deal with that problem in the first instance, because especially when you try talking to HIG or so, they don't even answer your emails, of course, because they know, okay, if you work on transaction that are like this had 300-400 million euros worth, you don't need automation somehow, because you have the teams and you have the money in the back. But as we are working with Amaniki together, and she's just, or this company is mainly focusing on small, maybe mid-sized transaction, and she has 20 years of experience, and she's saying, yes, it makes totally sense for us, especially, I mean, if you have the big transactions, you're doing it with handwork, but everything beside, which becomes somehow like CDE mandates, but you somehow should do it in the end or not. It's a try. I mean, it's somehow the feedback that you were describing, like for the big ones, it's way too early, but for a standardized small transaction, especially as said in real estate market, we are pretty, how to say, we have the inflow of insurance requests that verifies that we are now working on this idea. Let's keep it this way. So we have
Thank you very much. I'm sorry we don't have more time for this discussion, but I can introduce you later, so then you can discuss it if you want.
Up, please.
David, we have the next project, which is Emaku. Yana, please join us. Okay, now we can.
Does it work?
Yes, it's good.
Fantastic. Sorry for the. Hi, hello everybody.
Hi.
Sorry for the thing. So we are Imoku. We're still in the seed stage. Imoku is a tailored workplace platform that drives mental and social well-being through organization-wide coaching. Founded about 6 years ago, with an initial aim to increase emotional intelligence among workforce. And we have developed a range of products, including a SaaS coaching bot in form of a cloud-based web app to replicate any conversation digitally and give access to coaching at scale for employees, for line manager and below. Currently, we have over 1,000 pieces of micro content, video, audio, written content, covering everyday workplace challenges from dealing with underperformance, managing conflict, difficult conversations around bereavement. We have a data dashboard for management, measuring emotional resilience of employees, and we have semi-bespoke and white label solutions around culture change, around organizational values or negotiations. And here we see at the moment the biggest traction. So from the market, we know that productivity loss through mental health is just as significant as through physical health issues. And you have probably already heard some of the Gallup disengagement statistics. We are tackling these issues with preventative measures delivered in micro content developed by professional clinicians, coaches, and therapists. The total, I'm having trouble clicking here. The total investment up to date is 2.26 million with a mix of angels and institutional investors. Most prominent ones are from UK, Rupert Hambro and NCL Technology Ventures. We have some, I'm sorry for the slides. I don't know what happened here. That wasn't like this when I uploaded them. We have some traction so far. This year, we're looking at revenue around 225K in pounds. We have some customers who renewed for the past 3-4 years, ranging from engineering companies to medical, from defense to charity. And right now we're looking to bridge COVID-19 affected delays with a small raise of 175K, aiming at a bigger A round next year, early next year. This is also the time when we are planning to go B2C. The team is highly experienced and have built and sold businesses before. And in 2018, we also won the AXA Health Tech and U Award, and as well the Gold Award from Learning Technologies. That's it from me. I'm just gonna click through. I don't know what happened to the PowerPoint here. I'm very sorry about it. So that's the team. That's it. Questions, please.
This
Any
is a complex space for a variety of reasons. It's a little bit of Pandora's box inside the companies, because once you start talking about mental health and issues, you know, maybe something good comes out of it, but normally it just amps up all the tension that already exists in the culture of the company. So how do you do the sales? Do you have any metrics that show that actually it is not, that it does improve? What do you do? And so 2 questions. Do you have any metrics that show that basically the impact of your product is actually positive or net positive in companies? And the second question is more around, from a product standpoint, how do you make it work so that people are engaged? These types of products normally have very big issues in terms of engagement by employees. So even if I offer it to employees, people don't use it because they're afraid about their data, they're afraid about communicating. So could you tell us a little bit about those 2 things?
Yeah, so right now with the current product, with the chatbot, we see about 25% usage. For a non-mandated app, it's relatively high. However, so I recently joined the company just 2 months ago as a CEO. And from the product portfolio, exactly what you just said, it's very difficult to engage the user. So what we do is we have a personality type assessment. It's gamification. So depending on the assessment they do, the users do before they get on the app, we know what type of personality they are, so they can get challenges. They get people like them. They're like small animals. So there's we're sending notifications. We're also working with HR or learning and development people to really assess on what type of content the people need that is specific to their daily work, and therefore it is engaging for them because they get answers that are tailored to their actual work environment. That's one thing. On the measuring part, we have some measures. So we do see data. We can see how the emotional resilience is changing by using it. However, there's still some work to do, and we are currently in this process where we do, at the moment, new user research and new data strategy about this. So very fair point, and there's still some work to do.
Hi, Jana. This is Omiros from London. A couple of questions. I looked into this space before, and there are 2 major issues. One is, what is your right to play? I'm looking at the founders. I believe none of them has had the path, for example, of Tony Robbins. I'm looking at Tim and Jim, who have founded the company, right? So one is, what is your right to play? What is unique about this? And you're getting aggregated, effectively, input from 25 behavioral consultants, right? How do you differentiate from anybody else who can set up a group of 25 people and provide static advice? And the second is, how do you consider what is the outcome of that product? How do you make sure that you have customer satisfaction? And on top of that, how do you automate the process to reach an AI solution? Because the interesting part will be that as you interact with the software, it is able to understand your state of mind and guide you through the pathway of social interaction rather than a series of questions where you have static outputs, which effectively are if then else statements, right?
Yeah. Thanks, Omiros. So start from your last question. There, up until now, it was not necessary to do to put AI in it, but it's in the plan from the beginning. So right now we're talking to universities, specifically to the University of Kent in the UK, because they're strong in AI, and to do a partnership there. We have been in conversation with them already for a while and pretty much finishing that. So this will definitely become an AI product, especially if we consider to go B2C, it has to be. And this is also how the customer satisfaction will be achieved. The product, the coaching bot will learn about my personality, about what type of information I need at what time, and will provide this one to me. At the moment, we are about at the stage 2 of 10 steps of where we have to be in product development. And there is probably a possibility to pivot that. We're considering that as well. In terms of what is the right to be, is we specifically didn't pick any particular psychological or coaching route. So we say whatever that is, be it NLP, be it positive psychology, be it executive coaching type of conversation, anything of that has its validity. Everything happens in conversation. So depending on who you are and where you stand, and we are aiming at the, let's say, low-level employees who never get access to coaching, to one-on-one coaching. They get that replicated through a coaching bot solution, and they basically go through the average time this. Sorry? Did someone just say something? Okay. So, yeah, that's. Did I answer?
Yes. Thank you very much. I need to play Red Cop.
Thanks.
So that everyone has time.
Sure.
Thank you very much. Yeah, thank you very much. So next project is GT Digital. Gary, we're waiting for you.
Hi, my name is Gary Olson, and I am the CEO, founder, and technical designer behind Media Maestro and of GT Digital. And I'm not sure how we're changing slides. Yep, there we go. So the world has become a very dangerous place, and this is a global problem where we're all suffering from different kinds of attacks, and these are all happening in too many ways, too many places, where the people doing it are spending a lot of time telling people that they plan on doing these things. It's time we listen. Right now, the current challenge is that the vast amount of digital information that's available and accessible by just about anybody is overwhelming any human analyst professional to look ahead and to be able to determine that something is happening by intent, being plotted before it happens. Too often we're seeing it happen and then discovering that it was being announced and we had too much information and couldn't figure it out. Our product, Media Maestro, is built on a platform that was originally developed in cognitive computing by DARPA, for DARPA, and we curate, integrate, orchestrate, and correlate video, data, and media from any source that's open, accessible, and available, which is subscription, which is just a fee. And we don't collect it. We identify it, And then if it matches our criteria, then we bring it in and we correlate it to all the other different pieces of information that identify that there's a problem. If there are 10 different statements all saying the same thing, is it 10 different problems or is it one problem? We connect the dots between any and all information. We don't care where it comes from. We don't care what it is. We do the transcode. We do the normalization. We bring it in and we visualize it in a single pane of glass. Plot prevention is taking a look at everything and determining that there's going to be a problem, not that there was a problem. As I mentioned, our cognitive engines have been used by the US government and now available to us through our partners. We own it. It is our partners' technology. Our video technology comes from Emmy Award-winning, again, these are my partners, and my personal background is in broadcast technology. The reason you can all watch video is partially my fault. Cognitive intelligence is taking a number of technologies, pulling it all together to connect the dots. Recognition is a very mature market that is immature in its ability to be accurate. Searching and data mining in individual silos of data does not solve a problem. It only finds and isolates more siloed information. Correlating data is how it all works. Keeping the human in the loop is the most important thing, because the first question on everybody's mind is, how do you deal with false positives? And the answer is humans. Artificial intelligence is not at a place where it can make a decision. Artificial intelligence is a place where it can find enough information for a human to make a decision. Keeping the human in the loop means that the human understands what the problem is. The human has the cognitive understanding and deductive reasoning to trigger an action. We have a proof of concept. We're a cloud-based service or an on-premise service. We're currently pre-MVP. We're raising $750,000 to bring it from proof of concept into pilot. We're looking for an additional 1.2 million that will take us to full launch. This is an untapped $50 billion market. The market opportunity is in the commercial space. Stores, retailers, shipping and logistics, public venues are tired of being on the news, are tired of finding out why somebody is attacking them. They can get ahead of it. If there's a vehicle parked outside of a retail operation in the middle of the night, 5 nights in a row, either it's teenagers or it's a problem. We need to get ahead of it. Benefit for our client is saving lives, saving property, saving businesses, protecting a business's reputation, preventing the churn of employees and customers. Our executive team has built businesses for many people across many decades. We have an experienced team that has run successful businesses, and our design architects have built technologies that are being used right now in law enforcement. My name is Gary Olson. I thank you for your time and any questions.
Hi, Gary. Tom here. Thanks a lot. Interesting stuff. It looked like it might be a knowledge graph based solution, but even if it is, it requires training. So how quickly does the system learn, and have you been training it on specific use cases? And in those, how good has it gotten so far?
So the first answer is, it is not knowledge graph. It's actual visualizing what you see. So instead of charts and graphs and burning eyeballs, you see the video, you see the data, you see the map, you see all the information in a single pane of glass, and then that helps determine what the problem is. It creates a timeline. You can sync multiple videos. So it's not really a knowledge graph. It's actually visualizing all the information in a way that is easily identified for a human to understand. In terms of training data, depending upon who our customer is, the question is it based upon certain criteria that's programmed when the system is implemented with thresholds that determine what the data sets are and what the customer wants the data set to be.
So the system vision is, I think, relatively clear. The product piece, I'm not sure. So what is the product exactly, and how does it get deployed?
So it is a software product, and it follows a classic software model. So basically, it's installed on a customer's premise if they have a technology department, and then it's connected to open sources, and if they have private sources, it's connected
attached to their own cameras, to their own infrastructure. Is that it?
If they have that, yes. And if not, there's an extraordinary amount of information and cameras available in the open world. And then it's also a cloud product for those that don't have the technical depth that want to have an on-premise solution.
Can I still ask? I asked about the performance. You know how good it is in certain use cases, and even if it's not fully automatic, then the question is, how much does it improve the working lives of the people using it?
It improves the working lives of the people using it because right now they're all gathering data and then forensically looking to see what story the data is telling them, not preventing a problem, but identifying why it happened. More reactive than predictive. And predictive is a dangerous word, but we are more on the anticipation that there's going to be a problem as opposed to the reaction of how did that really happen. As far as training data goes, we are collecting some amount of training information, but more of it is text-based metadata. And by polling things and not collecting, it's not a question of collecting every piece of information that's available in the marketplace. It's basically taking a look at what's there and only capturing the information that matches the criteria. Omiros?
Elena, do we have time for a couple of questions?
Yes, 2 minutes.
2 minutes. Okay, I'll be very fast. You'll see me typing while you're talking, and the reason is I was making some notes. Okay, 3 things. Team technology track. Let me start with the team. I was a bit confused because initially you said that you actually have partners that have developed this and you license it. That's how I understood it. Then you came up with an MVP. So first question is, have you developed the technology? And second is, if you haven't, who has done it? Second question, team. What is the team? I've saw the 4 people that you mentioned. I'm on your website and I'm going into Crunchbase. I see that you started it back in 2016. Who is developing this? Because I see a team of 4 and I will imagine you need a lot more people to develop the software. Third, track. You started 2016 December. You have had a seed round a couple of times. What has changed over the last 3 years? Why have you not get track? And just to let you know, if that is something relevant, I actually have an investment in this area of cybersecurity. And one of our companies, Terracom, has the largest airport in the world as a client. So we very much are aware of this space, and I would like more to understand what you have done it. It's very different. We're into guard patrol management, but there could be quite a lot of synergies there. So very keen to understand more.
Okay, well, this may be out of order. So my partners are 2 technology companies. What you saw is the management team. And my partners are, one company has, as I said, they're a custom software company that has developed cognitive engines that is currently used by a lot of US government agencies. My other technology partner, and these are stakeholders, has developed curation technology in the video space. And I am the architect and designer behind the product that is using some of those technologies foundationally. And we've developed the proof of concept on top of this. We have no seed funding. We are self-funded right now. We are bootstrapped. Everything that we've done so far has come out of our own pockets. And from idea to proof of concept took some time, and proof of concept and looking for the additional funding we need to bring it to an MVP so that we can bring it. We have letters of interest from hotel operators. We've shown it to shipping and logistics. We've shown it to global organizations. There is no product in the marketplace doing this right now. It's an untapped market. We are not a cyber solution. This touches the physical space. Did I get all your questions?
I think, yeah, partly. There's a lot more to understand about what actually you're doing with the tech and the team, but I think for Elena's discretion, we'll take this offline. But thank you very much.
Okay.
Yeah, yes, I will be happy to introduce you and so that you can talk. We're waiting for you.
Hello. Who's bringing up? Are you bringing up my presentation for me?
You need to download it from documents, Lani. This the way we tried it before.
Okay.
Yeah.
Here we go. Okay. Hi, everybody. My name is Landry Rutkin. I'm the founder, CEO, and chairman of Click Deal Buy. It's a California corporation, Chapter C corporation. Actually, we're out in Nevada. Let me tell you, I apologize. I forgot to put my name, my email on here. So it's my first name, Lanny@clickdealbuy.com. And let's go right through this real quickly. We start my timer. Okay, moving these slides. Here we go. All right, Click Deal Buy. We're looking for a seed round right now, up to 5 million. So you know, all right. We have shares of common stock. We can get into that later. Let's talk about who we are. We have a great management team, including somebody who's way up at the top at Walmart. Okay. Somebody just blocked my presentation. I'm sorry.
I'm sorry.
Can somebody move that out of the way? Thank you. Okay. So we have a good team. There's no doubt about it. We have retail experts on our team. We know what we're doing. So let me tell you about who we are. Let's get to the meat of this. So we're solving one of the biggest problems out there in retail. That's the conversion rates on an international basis. Conversion rates, I'm sorry, these things keep popping up on my screen, sorry. If you don't know that the conversion rates can be very, very low across the globe when it comes to retail. Abandonment rates are very, very high. Imagine last year over roughly $900 billion left on the table because people don't complete the sales. So we have a whole new way for retailers to get the products out to their customers and complete the sales. So it's like the name says, there's 3 simple ways to do this. You click on a product or products. Just click on one or more products. You're going to get the best deal from that particular vendor you're at, and you can buy it. So it's 3 steps. Click, deal, buy. One or more products. To support that, we have projections, okay? We can talk about this later, but we can do hundreds of millions of dollars a year. We have all this documentation to back us up. This is no small endeavor. So really, what we're talking about here, and I want to go ahead and move a screen above me here so I can read some stuff. So we have a way to create unlimited deals for people to buy products. We have a way to increase, of course, conversion rates. We are talking about hyper-personalized interaction. We're talking about AI-driven retail. We have a patent that got published. If you click on an item on somebody's screen, right? If you click on anything, if it triggers a deal, that's our patent. If I scan something in a store and I click on it and it triggers a deal, that's our patent. If I scan a QR code and it triggers a deal, that's our patent. It's very powerful. It's good for any business, any product, any service. Now, I have a video here. I'm going to skip by that. We can put a deal button, a trigger button, anywhere on a screen. We have a software platform that will fit into anybody's platform. Shopify, BigCommerce, Oracle, you name it. All the major players is what we're going to put in there. So stores, that was a quick 3 minutes, sorry. So stores can place a trigger button anywhere they want on their screen. We have over 60 features on our software we're planning for. We've designed our software, right? You can't see it here, but we've designed it. We're ready to go. We compete with that e-coupon world, which is billions of dollars. How do we compete with the e-coupon world? We eliminate the need for coupons and codes. You don't need it. Just click on a product. It's all done on the back end. It's a global solution. We like to say that we have the 3 R's. We give the customer the right price at the right time with the right deal. And of course, I can't explain everything right now because I don't have much time. So for an investor standpoint, SaaS, AI, retail, e-commerce, that's a winner. A lot of companies never even knew how they're going to monetize when they first started. We know how we're going to monetize. We know the market. You know, the market is, of course, trillions of dollars globally. We know who the players are we want to go after in the United States. Of course, again, we work with all the favorite platforms out there. We will in the future. Again, we know the market. We've identified the low-hanging fruit, how to get to them up to the enterprise level of accounts. There's many other additional streams of software that are part of our vision that of course, I can explain to you in another way, in a presentation. We have all this down. We've been working on this for a couple of years. We have many, many, many marketing ideas. We have room in our, see, you know, because I didn't show the video because it takes time. When you click on something, a deal pops up on your screen. Okay, it's an interactive deal with timers, bells and whistles to get the people's attention. I can say, I want another deal. It may not be as good as the first deal. This has never been done before. We don't care what other people looked at or other people like Amazon, right? We don't care about that. It's what the customer wants. So we don't care if you looked at something. We don't care about that. It's what you want. And we know what you've been looking at. Let me give you an example. If you're buying toys, you might as well buy the batteries as a combination, right? We'll give it to you. If you're buying paint, here's brushes. You might say, I need 7 things to create, I want to paint with. Give me a deal on those 7 items. Some of the items you're looking for may be discontinued or end of life or overstock. The system says if there's too much inventory at a certain time, lower it accordingly to what the store allows and get rid of the inventory. So we can move inventory. We can do natural bundles.
Lanny, Tom here. I hate to barge in, but I actually think you spent much more than your allocated time. And since I have to go in 2-3 minutes, I still want to ask one question from you.
Please.
All right. So it does sound pretty exciting and not really knowing how it works. But if you're a let's say medium-sized merchant, online merchant, and you want to use this, what does it take in practice, technology-wise, time-wise, resource and skill-wise, to get this, going onto that merchant?
It's very simple. It's API-based, right? So what we're doing is we're tapping into the existing customers' database and allowing them to put buttons to create a deal. It's very, very simple to create a deal. I can create a deal for a product or hundreds of thousands of products literally in minutes. I can take a product by a SKU, by a category, an item code, and say I want these products associated with the deal. Let me give you a quick example.
But so there is an integration which hopefully is low frills and clear,
yes. And
then there is a self-serve for defining what kinds of deals you want, where and when. Is that how it
Very
goes?
much so. Right. It's unlimited incentives. It can involve 1 or more stores at the same time as well. Get this from one store, this from another. Yes.
Okay. Thank you.
We have a whole new way to push traffic to stores, to restaurants. It's a very big vision we've worked on for years. So it's hard to describe in a few minutes. Very exciting.
Any more questions?
If nobody else asks, I'll ask a follow-on question, which is when it comes to integration and platforms, are there any specific limitations where it may not run, or is it just wherever there's an online something?
Well, we haven't tried it with some closed platforms like Oracle as an example, but we don't think there's going to be a problem. We don't know yet. We don't think so. Other platforms, Shopify, Magento, we haven't had any problems at all. We have proof of concepts. We haven't had any problems.
Right.
Nobody's ever thought of this in the past. It's just brand new. Click on something, get a deal, and buy it. we have a way to beat Amazon. It goes on and on and on and on and on.
Okay, thank you.
Thank you.
Any more questions? No? Thank you very much for our dear investors. Thank you for your questions. I would be very grateful if you can please fill in the questionnaire which I sent to you, and I will send you all pitch decks of companies that showed up and companies that couldn't join as well. So thank you very much everyone for your attendance, and we are waiting for you at our next events. Thank you so much.
Thank you.
Thank you, Elena.
Bye. Bye.